I tell people RSPs are a scam, and I'll die on that hill that RSPs are a scam until the banks actually start changing their marketing material, because RSPs are a tax deferral tool, but they're not sold as a tax deferral tool. They're sold by all the banks as a fast way to grow their money. It's almost like they all wrote the exact same copy. If you start checking their websites, it's like it's sold as a fast way to grow money. And it's just not. If you want to grow money quickly, you do it with leverage. Okay. And the opportunities to leverage with it inside of an RRSP are very, very limited. Okay. So, then you start to get into the mutual funds and the listed and unlisted shares. And that, kind of ties in with your RRSP question, is those RRSPs are they're generally destined basically for a 50% tax rate when you die. Okay. And a lot of people will try to finagle around that and say, well, you can transfer it to the spouse. Yeah, you can transfer it to the spouse. And then they'll start to finagle around. It's like, okay, but if you die early, you can transfer it to your kids. It's like, yeah, but like read the fine print. Your kid has to bring it into income by the time they turn 18. And so if they die when they're 17, they got to bring it into income over 2 years. They're going to pay 50% if you have anything sizable on that. And most people are going to outlive their kid's 18th birthday. So like that's not going to happen. Basically, for the most part, if you have any substantial money inside of your RRSPs, when the remaining spouse dies, you're headed for a 50% tax bill, but that's going to get confiscated. And in between those 1.5 and 1.2 trillion in both mutual funds and listed and unlisted, listed and unlisted securities, it's like most people are not getting a great rate of return. Some of those they're in bond funds. Some of those are in money market funds. A lot of them have outrageously high fees attached to them, especially the 1.5 million in mutual funds. And a lot of them are in historically underperforming stocks that we've seen it decade after decade. And so right there, it's like the likelihood that you're going to, if for the last 30 years, this sector of the TSX has not kept up with an ounce of gold. Like, what's the expectation that's going to happen in the next 30 years? Like, how many decades of proof do you need to see before you realize that that's not a likely outcome? And so most people get eviscerated on the rates of return inside of those mutual funds and the securities that they're holding. And most of those, a large percentage of those funds is being held in RRSPs where it's destined for a 50% tax bill. So they're getting crushed by the inflationary pressures while they're holding the investments, and then they lose half on death. And that's, it's so-called, people think it's being transferred to the next generation. It's not. It's being transferred through inflation throughout your lifetime to the government, and then further transferred a large sum to the government upon death. And that's just the really harsh reality on that. And that's the part that most people aren't expecting. So.
Yeah. And, like when it comes to these, let's go back to mutual funds and insurance companies, they are for-profit businesses. These people who are managing these funds, they want to make a profit for their shareholders. They got to make a profit for their bank. They got to make a profit for their insurance company. So where do you think that profit comes from? It comes from A, your contributions, and B, they invested in higher performing assets so that, they win, and then they give you a pittance of the return. Not to mention a lot of these funds are also invested in what? They're in bonds, right? In currency, which is, seriously underperforming forever. Maybe talk a little bit about that aspect as well.
Yeah, I mean, if you're investing in any sort of fixed income, and that's like, it's like the game, and it's like the default where they're pushed into this out of fear, and they're told that you should have, your age, your percentage of your portfolio equal to your age in bonds. So if you're a 70-year-old, you're going to have 70% of your portfolio in bonds, even though decade after decade, it really shows that you're going to underperform stocks, you're going to underperform gold. And they're sold this because they're told that it's risky, but they do not understand the difference between risk and volatility. Okay, they're two different things, and they shouldn't be conflated. Okay, if you know something is not going to keep pace with the real rate of inflation over time, basically it's risky. It is a really risky asset to hold your money there for any long period of time. If it has 3 decades of performance where it underperforms the real rate of inflation, and you plan to keep it there for 2 more decades, it's like the risk is almost 100% that you're going to lose purchasing power and lose wealth. Okay, so and that's what most people are pushed into. And then we've done the podcast on it before. We explained it's like the reason why they're pushed into it is the person selling it to you probably believes that it's right because they've been confused confused between the difference between risk and volatility. But the people who train those advisors know full well that if the banks themselves don't have a market for those bonds, they're insolvent. So they keep pushing those on their investors. So it's a really tough realization. It's that wealth is actually not getting transferred. People think that if you have one of the parents who has they're part of the top 20% and they got a net worth of $1.2 million or more, that you're going to get that, and those kids are going to be lucky and the rest are out of luck. It's like the harsh reality is most of those won't benefit that much for it because they're going to go through these inflationary tactics and lose a whole bunch of taxation. So and there's a whole bunch of strategies. Like most people are wound into these RRSPs. It's like the goal is to wind yourself out. Okay, the goal isn't to be stuck with $1 million in RRSPs at the end and lose half. Like that's just really poor tax planning, and that's really poor estate planning. But that's often what people come when we see estate tax returns come to us after someone passes away. It's like usually that's the nature of it, right? And then you just look at the currency deposits, like $1.6 trillion held of currency and deposits. It's like that is a certain loser. It's like, what is the optimal amount of cash to hold? Zero. The optimal amount of cash to hold is zero. Okay. You want to now that's not practical in everyone's situation because you got to have the right debt structure and the right flexibility with the credit products that you have. But basically, cash is a melting ice cube. If you're holding a percentage of your net worth in cash, it's like just times it by 9%. That's the inflation tax that you're paying every single year to hold that. Okay, so that's the part that most people don't realize it's really hard for boomers to grasp this because at the beginning of their career, it's like they were taught at the beginning of their adult lives. Let's call it from 15 to 45, like their formative years where they're forming their opinions about the world. It's like it actually was structurally different. The system did reward people who worked hard and saved, and now it really rewards people who know strategically how to borrow money to invest. Like it's moved from the people who earn and save to the people who know how to borrow to invest. Like that's what it is. But that's a complete paradigm shift for the people who are hearing this for the first time. It's like they think they should bring their money to the bank, get a percentage of interest. Some of them are old enough to remember. It's like they got a 20% interest on a deposit in the 80s. It's like, well, that was a one-time event when they came off the gold standard in the 70s. It's like that worked its way through the system, and now we've seen what the effect has been for the last 30 years. And so it's really tough. The old, can you teach dogs, can you teach an old dog new tricks? It's like that's actually kind of what's required. And very few families will understand that and navigate through that because there's a lot of emotions involved there because what you were told was true and what actually was true 40, 50 years ago, it just simply has proven that it's changed in the last 30 years.
Yeah, I think there is a lot of fear that is involved with those decisions, right? So they make you fearful that volatility is bad, but really volatility is a good thing, especially if you're using dollar cost averaging into different funds, whether it's ETFs or stocks. If you DCA, it kind of mitigates some of that risk. It offloads it. Maybe explain a little bit about dollar cost averaging and the reason why you want to take that strategy going forward.
Yeah, like a lot of people are like, I don't want to buy an asset that has volatility. It's like, okay, you don't want to buy an asset that has volatility. that's a very good reason to not buy that asset all at once. But it's a very bad reason to put all of your money or substantially most of your money into something that you know will lose purchasing power over time. Ways to mitigate that risk is basically to buy small amounts over long periods of time where you know that sometimes you're going to buy at a good valuation and you're going to buy at a bad valuation. And that's actually how you mitigate the risk rather than put it into something that's not volatile, but 100% risk of losing purchasing power. And so and the other way that people just don't really wrap their heads around is managing volatility. It's like you don't have to avoid volatile assets to avoid volatility of your net worth. What you have to do is acquire assets that are not correlated to each other. So rather than acquire assets that underperform the real rate of inflation, you should have assets that are not correlated to each other. Owning stocks and owning real estate and owning gold and owning Bitcoin. It's like all of a sudden you start to get into these assets that are not correlated with each other. Most of the bank advisors won't even go down that because they get a commission to sell the financial assets. They get a commission to sell the mutual funds. That's what they're getting a commission to do. They don't tell you, it's like, hey, you could have just bought an ounce of gold, paid a 6% fee, and kept that ounce of gold in your family for a couple of 100 years and never paid anyone again. So that's a realistic scenario, but it's a very bad business model for a lot of the banks. So they don't talk about that. There's a difference between volatility and risk. And there's ways to manage the volatility of assets without being forced into assets that underperform inflation.